Good evening, everybody. Thank you very much for joining in. This is 81st in the series where we're going to speak about the accounting of debt and equity financing. This being the first part of the video, wherein we are going to speak about the accounting for debt and equity instrument. We are going to cover the following types of debt instruments we are having in the accounting of debt, which is ASC 480. ASC stands for Accounting Standard Codification 480. So we are going to deal with basically Accounting Standard Codification 480, and in this we are going to deal with zero coupon bonds, term extending bond, share settled debt, index debt, exchangeable debt, inflation index, which is in US is shortly known as TIPS. You have perpetual debt, you have step up debt, you have debt having a bad option, which is one of the more important. But before to start ASC 480, I would like to give you a brief intro because this video is going to have not less than 15 minutes. Well, what is debt? Debt is nothing but the amount taken up by a company, financial institution, people, corporation, anyone to basically run their working capital. Today we have a lot of companies in India, worldwide, Asia Pacific who are having huge amount of debt in the books. Take an example in India, it is Reliance Industries Limited who is having INR equivalent of 1,40,000 crores of debt in the book. Take an example of Reliance Communication, the other set of Reliance, which is having 1,22,000 crore of debt in the books. And you have lot many examples. You have Jindal Steel, Indian Oil Corporation, petrochemical companies and the various importers who are having huge amount of debt in the books. So debt being a very important part right now coming in the books of all the companies. And in fact, to be honest, there are very few IT company. IT stands for information technology. So there are very few information technology company left in India who do not have any debt in the books. Elsewise, majority of the companies pertaining to information technology or information technology enabled space are reporting the debt in their books. So the accounting of debt and equity turning out to be very important when it comes to very important not only for exporters but also for exporters. It may be possible that today you are acting as an exporter and it seems that you are having free cash, so you're not going to take any kind of debt in their books. But who knows when you're going to have debt in the books? So it is very much important for a global controller, a person who is doing a consolidation of the books, to try and understand that this is how the basically accounting of debt and equity financing would continue. Move on. I again would like to would again like to stress the fact that we are going. This is for part 1 of the series, wherein I am going to introduce you to the various kind of debt. We would have the 5 parts, and in all the 5 parts we are going to move on. Like the first part is going to be intro. Second part I will introduce you to the 3 types of convertibles. Today we are not going to speak about convertibles, but part 2 we are going to speak about convertibles, and so on and so forth. So let's move on. A company hereby because I am assuming that here in this video I am taking an example of a company which is very well known in India. I will assume Reliance Industries Limited when it pertains to India, or I will assume ExxonMobil, which is an American company. So both are almost in the same kind of business. Both are in the business of the oil and petrochemical business. Now, what do you mean by zero coupon bond? A zero coupon bond is a bond which is issued at discount, however, to be payable at maturity at par. So, take a very simple example. Reliance Industries Limited in India and ExxonMobil outside India, they are digging up a well, or they will get to know there is some place in this earth wherein there is a probability of having an oil. But to dig the oil to the earth, it will take a huge amount of money, time and effort. So, both companies estimating that it will take $2 billion of cost to take out the debt from to take out the oil to the earth, basically to take it to the higher levels. Then they will add the profit margin of, say, I am hereby taking 100%, and the selling price is going to be $4 billion. That's going to be the selling price. But as of now, the cash flow situation seems not very good with both the companies, or both the companies do not have the sufficient amount of cash in their books. So both have decided to basically move on. Both have decided to take a kind of debt in their books, and they are evaluating the following options in the market. So a zero coupon debt means, and hereby again example, it is 20 years. So the debt is not going to be shorter tenor, it is going to be a longer tenor. Predominantly debt is of three types. In India, the debt, I'm talking from a government security. In India, the debt is of three types. Number one, you would say a discounted kind of debt, or short, which is 0 to 1 years. Then you have a second kind of debt, which is notes. Some people refer as a medium term notes, which is 1 to 10 years. Then you have a third kind of note, which is known as bonds, which is 10 years to 30 years. Please be note that there is no criteria available in the world which suggests that bond can maximum be of 30 years. Bond can also cross 50 years. So you can have a 50 years bonds, and you can have a perpetual bonds as well. So it is up to a company how they're going to take it. Basically, how big is the credit rating, or how effective is the credit rating of the company, so that they can take the higher amount of debt in their books. So zero coupon bond means Reliance or ExxonMobil would issue, say, $1.6 billion. They will take $1.6 billion, and on maturity, say, they will pay $2 billion. But please be note that in this there is a risk. There is no risk of reinvestment, because obviously you are not going to receive a periodic coupon. However, at the same time, there is a big probability of losing the money, because at onset you are paying $1.6 billion and you will get $2 billion after 20 years. So after 20 years, anything could happen. The project would fail, the company would go into bankruptcy, anything would happen. At the same time, being a corporate treasurer, you need to understand that there is no reinvestment risk in the book. Basically, you are not getting the periodic coupon, so there is no reinvestment risk in the books. Term extending bond means, like Reliance is saying, it will take 20 years to dig a well, but some estimates suggest that the cost of digging by go up to greater than 2 billion. Basically, it will go to 25 years. So Reliance would issue a debt which is known as term extended bond. Now this is the feature. Here I am assuming they are issuing a zero coupon. So in this term extended bond, at the end of 15th year, say I am here assuming at the end of 15th year, Reliance would estimate that yes, now it will take another 3 years to dig up the oil, to dig up the well, take the oil, and so on and so forth. So it's better we should extend the debt. So if there is a clause of term extending bond, then Reliance would increase the tenor from 20 years to 23 years, and obviously the coupon would rise. Well, please note that generally speaking, term extended bonds would link up with step up bonds, because if you are extending the term, you would have to increase the interest rate. In nutshell, step up bond means a bond wherein the interest would continue to rise. Take a very simple example. If you have a zero coupon bond which you are issuing for 20 years, now you are going to have that kind of structure in your books. So the first 5 years you are going to pay, say I am assuming the net rate. The rate is 10%. 5 to 10 years it will go step up, 10% plus 1%, which is 11%. 10 to 15 years it will go 11% plus 2%, which is 13%. 15 years to 20 years it will go 13% plus 3%, which is 16%. This is step up. Majority of the times we have saw step up in a zero coupon bond, because the coupon dated bond never would have a step up unless otherwise the company who is issuing a coupon dated bond is good for nothing. There are various examples of good for nothing companies. Elsewise, you are going to assume that the zero coupon bond generally would have a step up structure attached. Third is the share settled debt. So here you are issuing, say, zero coupon of $1.6 billion, and you are giving them a share. So on maturity, rather than paying in cash, you are saying that you take example, one bond is a 1,000. At the moment, Reliance is running 300 shares, 300 rupee per share. So you are going to say the one bond would have 3.5 shares. Please be note that share settled debt could have numerous structures. It depends upon company to company how they are taking it. However, generally speaking, share settled debt, the strike ratio, like here I am saying the strike ratio is 3.5 to 1. 3.5 my share, once your bond is generally fixed. However, share settled debt could have any kind of structure in the books. Fourth is exchangeable debt. Exchangeable debt is a very new kind of debt in the books. Exchangeable debt means Reliance Industries Limited is not going to pay you the cash. Rather than it will pay you a share, as earlier said, but the share is not of Reliance Industries Limited, the share is of some other companies of Reliance Industries Limited. So Reliance Industries Limited as a group would have, say, various sister concern. So rather than issuing the shares of his own principal firm, they are going to issue a shares of any of the group companies. That is exchangeable debt. And basically you can have a various features of exchangeable debt. Fifth one is the inflation index debt. In United States, this is known as TIPS, Treasury Inflation Protected Securities, where they will link with the Treasury. So you are not going to have the stated coupon, like you are issuing a 30-year debt at the rate of 5%, not at all. You are going to link this with the inflation. So you are going to issue CPI every year, every month, every 6 months. It's all between the issuer and the lender, and you're going to link the interest rate with that CPI. So if the CPI would move, the interest rate would automatically move. If the CPI would fall, the interest rate would automatically fall. The last but not the least, you would have perpetual debt. You know, perpetual debt is always treated as a liability because you don't know the period of the debt. It's going to be a longer tenure. Unfortunately, in India, we do not have any kind of perpetual debt, but worldwide at Asia Pacific level, there are various companies who issued perpetual debt in the books. So perpetual debt is nothing but a liability. Last but not the least, debt having embedded option, which we are going to cover in the second part. But for the introduction, embedded option is nothing but an option which is hidden in the bond. So you would have, generally speaking, embedded option is of three kinds. You would have embedded features, you would have call, or you would have put. But other side of embedded option is you would have symmetrical embedded option, which is embedded option. You would have embedded forward. Embedded option would have asymmetrical payoff profile, and embedded forward would have symmetrical payable profile. So let me write here again. Embedded is of three types, basically of two types. One is asymmetric, second is symmetric. This is generally known as embedded options. This is known as embedded forwards. To nutshell the entire video, you can have various kind of debt. Zero coupon bond means you pay me $1.6 billion, I will pay you $2 billion after respective period. Term extended bond means if you think that the cost would get rise or the payoff period would get rise, you can have a term extended. You can increase from 20 years to 23 years. Share settlement, you're not going to pay in cash, you will pay in shares. So at maturity, take an example, the Reliance is saying 1 out of 3. Or say 3.5. Today Reliance is trading at 300 rupees. So you are saying one bond would have 3.5 Reliance shares. Obviously you would have conversion premium in that, but there are, as I earlier said, there are billions of kind of share settled debt. You can have any kind of share settled, which cannot be explained in one video. You would have index debt, wherein you are going to link with an indexed. There are various kind of index. So if the index would go rise, the payoff would go higher. If the index would go fall, payoff would obviously fall. You have exchangeable debt. You are going to exchange. It is a form of a share settled debt, but please be note that in this you are not going to pay the premium. You are not going to pay the share of your principal company. Rather, you are going to pay a share of some subsidiary concern, or it may not be a subsidiary concern. It may be a target you just acquired as of now. So Reliance acquired a target called SR Oil, and they issued a zero coupon bond, and we are assuming it's exchangeable debt. So they are going to link with the shares of SR Oil. You would have inflation index protected securities, which is known as TIPS. Shortly in US, wherein the coupon rate is not fixed, it links upon CPI. You would have perpetual debt, which is of course a liability. You would have step-up bonds, like mentioned here. 1 to 5 years it was 3%, 5 to 10 years 1% rise, 10 to 15 years 2%, 15 to 20 years 3% rise. The last but not the least, you would have debt having embedded option, which we are going to cover very much in detail in the upcoming videos, because this is a 5-part video. Embedded option is one of the most difficult option to understand, and embedded option is far different from freestanding options. Please be note that when it comes to accounting for debt and equity financing, which is ASC 480, embedded options and freestanding options all are different. So both are not the same, but unfortunately